It's Friday 19th of July, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, China's third plenum. Did this key Communist Party meeting deliver the goods on the economic reform front? But first, Neil's out this week, but I'm happily joined by Jennifer McKeown, Chief Global Economist, to give her take on the week gone by and set us up for the coming 5 trading days. Hi, Jenny. Welcome back to the podcast.
Hi, David.
I want to get on to what's happening on the global inflation and monetary policy front. But before I do, we've got to talk about these global outages that have swept the world since the early hours of Friday. On paper, at least, it looks like massive disruption, got all the makings of a big supply shock. With the caveat that it's still all very uncertain, what do you think the macroeconomic implications are of what's going on?
Yeah, it is all very uncertain at the moment, David, and probably will be for some time. I think what we're seeing at the moment is that a lot of economies have obviously been affected and various sectors, including transport, some retail payment systems, shipping, some shipping companies seem to have been affected, and also health services. So obviously that latter effect means that there are much bigger and more worrying implications for human well-being than purely the economic ones. But what we can see so far from the economic side is that financial markets that haven't been too badly affected. In fact, if you didn't know that this IT outage was happening at the time of recording, you wouldn't necessarily discern that there'd been any major disruption in financial markets. So that suggests that the financial crisis type risks that we've previously warned could be the biggest consequences of major IT outages should be avoided.
So we're at the beginning of a weekend. A fix is already being rolled out. Let's assume that continues. Let's assume this all gets sorted out. Not enough here to move the dial on the near-term economic outlook.
No, I don't think so at this stage. As you said, a fix is being rolled out. That will take time to be implemented, not least because my understanding is that it needs to be implemented by IT professionals. So the sectors that are best placed here are those where there is very strong IT support. They should manage to come off relatively unscathed. But for some other sectors, there will be much bigger impacts. I think one source of comfort here is that this doesn't seem to be a cyber attack. In fact, the chief executive of CrowdStrike itself has ruled that out. So that probably limits the likely disruption, hopefully means that we can be back up and running quicker than would otherwise be the case. We've previously actually done some work on what the potential implications of a major cyber attack would be. And even in that case, which is not where we are now, we think that an outage of around 3 days that halved output in the advanced economies would only hit world GDP by something like 0.2%. So I think that would be at the very extremes of the kind of damage that we're looking at. And I think there's probably a more minor impact to come.
And even as we're recording this, I can hear a ping, ping, ping of emails coming into my inbox suggesting that whatever was blocked is getting unblocked. We will obviously keep an eye on this situation. But for now, let's turn to the global inflation question, because the global inflation picture, we've been bouncing between 2 poles over the last week. And it seems to sum up just how mixed the global inflation picture really is. So for the US, we had June CPI, showed disinflation very much in train, and the release was greeted with exuberance. But then in the last day or so, we've had UK CPI, which was soundly disappointing. Not so much the headline as what the underlying numbers showed. So what do the examples of these 2 economies tell us about what's happening under the hood of global inflation?
Yeah, well, you're right. Those 2 releases were really very different. In the US, Fed Chair Powell's told us that he wants more good data before he can be convinced that it's time to cut rates. And I think that's absolutely what he got from the June CPI release, which showed the annual inflation rate down to 3%, core inflation at 3.3%. There's a clear downward trend there. And what's even better is that the US PPI release, that the components within that's irrelevant for the Fed's preferred measure of inflation, which is core PCE services ex housing, they point to a slowdown in the 3-month annualized rate to just 1.8%. So that's consistent with target now. But on the other hand, in the UK, we've had bad news. Headline CPI inflation was in line with the 2% target in June, but services inflation was stuck at 5.7%. And even worse, the 3-month annualised rate, 7.8%. So essentially, globally, there's just not one story. The US has tended to be a bit of a leader in the inflation cycle, both on the way up and on the way down. So the hope really is that the US is now continuing to lead down and that other economies will follow it.
I mean, that's key, isn't it? That this question of whether other economies are going to follow. What we're seeing in the UK and other examples I'm sure you'll talk about, is it just a case of delayed gratification, or are there risks that inflation is actually going to be harder to bring down further from where we are, and that the sort of the easy wins have already been won?
Yeah, there is an element of that for sure. The initial falls in inflation around the world really were strongly related to commodity prices. The outright falls in some commodity prices, of really steep falls in commodity price in inflation. And that brought down energy and food CPI, but also some services, things like restaurants and transport. They're very closely related to what's going on with food and energy prices. So those were the easy wins. They are now behind us. And at this stage, we're reliant on the labour market really to do the heavy lifting. And labour markets are still tight pretty much across the board. We're encouraged by broader labour market indicators such as vacancies and job quit rates. They all suggest that there's a loosening of labour market conditions underway, even in the UK, actually, where wage growth is so high. And it's also a relief that inflation expectations still seem consistent with banks' goals. So that suggests that really the wage bargaining process needn't come off kilter. It needn't be the case that we see persistently high wage growth.
I mean, you talk about the gradual disinflation process, but what about the signs of economic recovery in the UK and in Europe? Do they pose upside risks to the inflation outlook? And if they don't, what are the risks here?
Yeah, that's a good point. It certainly seems to be the case that the UK and the Eurozone now thankfully recovering. And essentially the Fed's playbook has been that while the economy is faring relatively well, why would you need to cut rates? Why rush to cut rates at a time when the economy is faring well and there are still some lingering inflation risks? But I think there are 2 points to make on that. One is that monetary policy takes effect with a lag. Economists often talk about those lags being long and variable, and that they're very hard to pinpoint. But the point is that there's still some pain to come from previous policy tightening, and any reduction in rates now won't affect the economy for some time. So central banks need to try to act preemptively if they can at all. And then the second point is that we know interest rates are high. Again, it's difficult to say what the neutral or equilibrium rate is, but we're sure that current rates of 4 and 5% in the major advanced economies are restrictive. So if the inflation outlook permits it, it's wise for central banks to try to normalise policy, even while the economy is still faring relatively well. And that doesn't mean adding stimulus, but rather reducing the extent of policy restriction that we have right now. But first, of course, they need to be confident that inflation is heading in the right direction, at least. So we are clearly in the midst of a global monetary policy loosening cycle. 11 of the world's 30 major central banks have already begun to cut interest rates. And we expect that cycle to broaden out to more banks. By the end of this year, we think that 20 central banks will be in loosening mode out of the world's major 30. And aside from the height of COVID, that will mark the most synchronized loosening cycle since the global financial crisis.
Flip side to that point about acting preemptively, and actually comes from a question that a client was asking in the UK team's briefing on Thursday, just after the release of the latest employment data. And they were talking about how now their expectation the Bank of England probably won't start cutting rates until September. But the client is asking about the 2% targets, this central bank inflation goal. The Bank of England has inflation back at 2% already. Other central banks are on the way to 2%. So why isn't it the case that once, in the Bank of England's case, once they hit 2%, it's mission accomplished, cut rates? I mean, what's the point of having that target if you don't act on it?
Yeah, well, I think the point there, it's a very good question, but the main point is that these targets are for inflation over the medium term. They're not for inflation to be at 2% day in, day out. It's just that inflation should settle at about 2% over time. And the problem with the 2% currently is that it's not reliable that rate will be sustained. And that's because it's been dragged down a lot by energy effects and food effects, while core inflation, which is the part that is more persistent, that tends to be more stable, and services inflation in particular, it is still too high, pretty much across the board, but particularly in the UK. So it would be dangerous really to declare victory just because the headline rate is at 2% when some of these core measures and wage growth are still much higher at close to 6%.
You've just published a note which looks at the global inflation picture and looks at where you kind of group central banks into these various categories in terms of where they are in terms of their fight against inflation. And you single out Australia, and it's an interesting and a special case because the debate in Australia really isn't when to cut, but actually whether the RBA should raise rates again at its meeting in August. What's wrong with Australia's picture? Given all that you've said about DM inflation trends, why does Australia stand alone?
Yeah, well, in most other economies, while inflation is still too high, it is heading in the right direction. So that gives, to the extent that a central bank is trying to be a bit forward-looking, that offers them a lot of encouragement that normalising interest rates is the right thing to do. But in contrast, in the Australian case, it's the monthly CPI indicator for Australia. It suggests that headline inflation accelerated for the third month running to 4% in May. So things are going in the wrong direction. The Reserve Bank of Australia didn't raise interest rates as far as some other central banks. The rate there's at 4.35% now. So I guess there's some concern that perhaps that they didn't go far enough, and that maybe given this renewed uptick in inflation, that's a sign that interest rates aren't high enough. But we don't think the RBA will hike again, largely because the economy is very weak. The Australian economy, GDP barely rose in Q1. Unemployment is rising. So we think that it will be very late to the loosening cycle, given these persistent price pressures that we're seeing and this recent renewed pickup in inflation. But we don't think another hike is to come. We've penciled in the first cut next May. So that will be 8 months after the US Fed.
I should correct myself. I said Australia stands alone, but actually there's always Japan.
Yeah.
Special case in the DM universe. We've got that BOJ meeting at the end of the month, and I think we will be devoting time on the podcast to discuss what we think is going to be probably the second rate hike in the BOJ this year. But Jenny, before you go, I want to ask you, you've described these disinflationary forces. You've spoken about getting back to 2% eventually. You've described this an easing cycle that's in train and is going to be broadening out, if a bit slower than had been assumed a few months ago. But how low does inflation fall, and how far does this easing process go? So look ahead a year or so and talk about what that picture looks like. If the world of zero interest rates is dead, what is going to replace it?
Yeah, I think that world probably is in the past. We're expecting over the next year or so, we're expecting a normalisation, but there's a new normal. By the end of next year, we think that US interest rates will be around 3.5%, the UK about 3%, the Eurozone 2.5%. And that's a bit higher than we were used to, kind of pre-pandemic in the 2010s. It was the case that interest rates were significantly lower than that. But we think that the equilibrium has risen, and those kinds of rates are, I think, what we should now get used to. And in major advanced economies, we think that inflation will be around 2% targets. That sounds predictable, but that's actually a bit higher than has historically been the case. And you probably remember that for a long period, inflation was typically undershooting targets, but we think probably in future that won't be the case. Now, that might all seem like quite a leap of faith, quite a Goldilocks kind of scenario, but forward-looking indicators and fundamental economic determinants do point in this direction. And I think perhaps contrary to conventional thinking, there are risks in both directions. Yes, services inflation looks sticky. You might be concerned that it's become permanently dislodged and that inflation is going to be significantly higher in future. And there are various risks around politics,
particularly potential inflationary effects of the tariffs that have been proposed in the US. But I think also there are some signs that previous tightening is affecting economies now. So it's possible that the lags from policy tightening are even longer than we thought, and that there's much more economic pain to come. And in that case, we could be looking at much lower inflation and interest rates in a year or so's time.
Jennifer McKeown on the global inflation and policy outlook. And look at that. We talked about services inflation without mentioning the Taylor-Swift effect, because here at Capital Economics, we're not clickbaity. Jenny's done a couple of notes on what's happening with services inflation and the global policy cycle, and I'll add both of those to the podcast notes. On inflation, the latest reading of that US PCE measure, that's the Fed's preferred inflation gauge, that's out this coming Friday, so watch for our coverage of that. Jenny also talked about long-term equilibrium real interest rates. Jenny and the team completed a major project on R-Star last year, and it comes with a special interactive dashboard showing everything from long-term savings and investment projections to financial market implications, and of course our long-term R-Star estimates across major DMs. It's one of a large range of interactive dashboards covering everything from GDP nowcasts to US-China fracturing. And if you're a CE Advanced subscriber, you get access to the underlying data to work with offline. So find out more about CE Advanced at capitaleconomics.com/advanced. Two events to highlight in the coming week. On Thursday, there's a special drop-in. That's one of our short-form online briefings, all about what would happen if Donald Trump were elected and made good on his pledge to end the Ukraine war quickly. Our EM and commodities teams will be talking about everything from Russian sanctions to how gas prices would trade to potential global economic impact, so do tune into that. The drop-in is linked to a new report all about this issue, and I will add both to the podcast page. Before that, on Monday at 9 a.m. London, 4 p.m. Beijing, there's a briefing on the third Plenum. This is a key meeting in the Chinese Communist Party calendar. It's just wrapped up in Beijing with a communique and a press conference, and it's why we're sending this podcast a bit earlier this week. Third Plenum meetings have been associated with big reform pushes in China's past, not least the start of the opening up and reform period in 1978. A fuller report from the Plenum, what they call the decisions, is due in the coming days, but ahead of that, you're going to want to hear what it all means from Julian Evans-Pritchard. He's our China economics head, and he's been following closely the shifts in the economy and policy leading up to the meeting. So is this Plenum likely to mark another big reform push? It's a reasonable question given the poor state of China's economy and what the government has and hasn't been doing on the reform front. I spoke to Julian earlier today, and I started by asking him that very question.
Well, we obviously don't have the full decision document yet, so it's possible that there could be some surprises hidden in there. But so far, the communique suggests that it's pretty much a continuation of the existing policies that we've already seen in the past few years. Generally speaking, the objectives that the leadership have laid out are reasonable ones, talking about achieving high-quality development, a focus on quality over quantity, less reliance on debt, more reliance on productivity gains. They even mention total factor productivity, which is music to an economist's ears. But I'm not so convinced that they have the right policies to achieve that. And that's sort of very much apparent in the focus of the communique. It does pay lip service to the idea of giving market forces a greater role in resource allocation, but that's something that we've heard before that hasn't really been followed through on. So I don't think there's really a reason to think that this time will be any different. The bulk of the focus of the communique is still very much on industrial policy, shoring up economic security, boosting the supply side of the economy. And there's relatively little in terms of the focus on the demand side and on supporting household incomes and consumption. And our view really is that what we need to see for the economy to get onto a more sustainable path is a rebalancing away from investment towards consumption. Unfortunately, it seems that they're going to continue to pursue policies that favor investment over consumption, and we're likely, as a result of that, to see further macroeconomic imbalances, continued downward pressure on prices, the economy at risk of re-entering deflation at some point. So I think they have the right objectives overall, but largely speaking, the wrong policies to achieve those.
Since the communique has been published, we've also had a press conference in Beijing on Friday, shortly after we're recording this. Did anything come out of that in terms of putting flesh on the bones of what was decided at Plenum?
We didn't learn a great deal more. Things were fleshed out a little bit in some areas, talked a bit more about fiscal reforms, etc., but nothing that we weren't already expecting. I think perhaps the most interesting area where we got some signals from the press conference is actually on the near-term policy outlook. So one thing that was quite unusual in the Plenum communique is that it briefly discussed the current economic situation and mentioned the need for additional policy support in order to achieve the current year's economic targets. And that was something that was reiterated in the press conference as well. And they mentioned in particular that fiscal policy needed to be stepped up, bond issuance accelerated, and fiscal spending accelerated in order to ensure that the economic recovery gets back on track.
So interesting suggestion of near-term support, but let's look longer term. I was in Beijing in 2013 when the communique from that plenum came out, and there was such excitement, at least among China economy nerds, about this language of giving market forces a decisive role to play in resource allocation. Xi Jinping had just arrived on the scene, fairly recently at least, but there was this real sense then that the economy was drifting on the steroids of GFC era stimulus. And so this language about decisive role gave a real sense that, fundamental market-based reform was coming, that they really were going to push on this. Now we've got this latest Plenum communique, and the language there is about giving better play to the role of the market. Is it significant that the language has changed, or given how disappointing the years following that 2013 Plenum have been in terms of market reform, does it not really matter?
Well, I think the language is interesting, but I think it's more important to focus on the actions that the policymakers have carried out over the past decade. And I think based on the policies that were announced a decade ago, the ones that were implemented and the ones that were not implemented, it's quite clear that Xi Jinping favors a sort of more state-driven, top-down economic framework. And I don't think anything that came out of the plenum this time really changes that picture. If anything, you could argue that the shift in language is actually downgrading the role of market forces in the economy, because although they talk about better leveraging the role of the market, you could argue that that's a bit of a downgrade from the market playing a decisive role in resource allocation. And alongside that language about the market playing a larger role, there's a lot of talk about the need to regulate market forces to ensure more orderly competition, to address market failures. All of that points to a view among policymakers that yes, we need market force, but we need them to be better controlled and better serve the interest of the state and the party. And so that suggests that the direction of policy that we've seen in recent years with the state sort of stepping in and tightening regulation in many areas is likely to continue.
Yeah, so a not so invisible hand of the state. Your response to the communique that you published on Thursday talks about these competing policy priorities, tensions that you described. Expand the supply side, but boost consumption. How do all of these ultimately get reconciled, or don't they?
Well, I think it's very hard to reconcile these different policies, and that's part of the problem with the reform agenda, is that essentially the leadership wants to do everything at once. They want to have their cake and eat it. But the reality is that a lot of these supply side policies are only possible by redirecting and channeling fiscal resources that otherwise would have gone to households towards the corporate sector. And so if you want to, on the one hand, continue to sort of heavily subsidize investment in key strategic industries, but at the same time, you want to provide more resources to households, the only way to do both of those things at the same time would be to significantly relax the constraints on fiscal policy. So essentially, borrow at a much faster pace than what the government is currently doing. But then at the same time, they're saying they want to diffuse the risks around government debt and perhaps slow the rise of government debt. So those three different objectives are not really compatible to do all at once. So they'll have to sort of prioritize one or the other. So far, they've generally prioritized the focusing on the supply side. And that's because if you think about their top concern at the moment, it's really to do with geopolitical risk, national security, and the dependencies that they still have in their supply chains in terms of their reliance on Western technology. So their key priority really is to reduce those dependencies. And the fastest way to achieve that is to focus on industrial policy and supply side measures, which is why the efforts to boost the demand side tend to sort of play second fiddle.
Kind of segues nicely to my next question, because you mentioned local government debt risks. I mean, it's one of these great known unknowns in terms of risk to the Chinese economy. And there was a shout out to it, along with risks from real estate and small and medium-sized financial institutions in the communique, specifically on that question of local government debt. Does the fact that it gets a mention, is there any suggestion now that there will be a meaningful effort to get to grips with this giant mountain of debt hiding in the provinces?
Well, they've been talking about dealing with this for a long time. I mean, this was a theme of the 2013 Plenum as well. And then shortly after that, they enacted a new budget law in which they tried to sort of bring all of this off-budget borrowing by local governments under control. And that sort of partially succeeded, or at least temporarily, but then very quickly they found other channels through which to continue to borrow. And the big picture is really, despite those efforts, there hasn't been a huge amount of progress in controlling the rise in government debt. It continues to sort of climb at a pretty steady upward pace. I think they are getting more concerned about that, and in particular in some regions, the level of debt is becoming very difficult for local governments to sustain, particularly given the slowdown in the sharp declines in land sales as a result of the property downturn. So there is a bit more pressure at the moment to address these issues, and the press conference that we had today kind of gives some indication of what policies they're looking to enact. And I think the key one really is shifting fiscal resources from the central government to the local government, and essentially helping to socialize some of the debt and the losses, because there's a huge amount of variation between the stronger provinces where the economy is in relatively good shape and some of the weaker provinces. And what needs to be done to sort of address the debt risk to some extent is to kind of socialize those losses and for the central government to use its balance sheet to absorb some of that debt. And that seems to be the direction that things are heading in, which would be a positive development. But I think it's probably not the most important thing to focus on, because at the end of the day, we're talking about moving money from one arm of the government to another arm of the government. And I think what really matters from a wider macro perspective is how the government's money is spent. And that sort of comes back to my earlier points about sort of whether the government should be giving more money to households or continue to support industry and the trade-offs that they face there. And I think that's really the key thing to focus on, rather than the sort of where the debt lies in the system.
Right. Before you go, put some growth forecasts on all of this. Where do we see growth this year? Where do we see growth towards the end of this decade?
Yeah, sure. So for this year, we are relatively optimistic. We're forecasting growth of 5.5%. Clearly, Q2 was a bit weaker than we'd hoped, just 4.7% on the official figures. That's clearly triggered the concern of the leadership, as we saw from the Plenum communique. So we're hopeful that in the near term, there will be a bit of a ramp up in support. A lot of governments already have funds at their disposal, but haven't spent them yet as a result of the relatively supportive budget that we got this year. So potentially could step up spending quite quickly. The other tailwind at the moment is the export sector, although, of course, there are major geopolitical risks and the threat of significant tariffs. A lot of those tariffs will only come into being, won't come into being for some time, probably until next year. And so in the near term, exports could continue to do very, very well, particularly given that Chinese exporters are gaining competitiveness relative to most other countries. So the near-term outlook still looks okay to us. Where we're more concerned is about the medium-term picture, given that there are these growing imbalances in the system. Domestic demand growth is pretty weak. Investment remains strong, but that's not really sustainable. The longer that continues, the more you're likely to get a renewed slip into deflation as the supply and demand imbalances become larger and larger. So we do think over the medium term that the Chinese economy is likely to face a continued structural slowdown, and the reform agenda that was announced at the Plenum doesn't really seem to address the issues that are driving that structural slowdown.
Julian Evans-Pritchard on China's near to long-term economic outlook and why China's reform quandary isn't going away anytime soon. I'll post all our Plenum coverage on the podcast page. Don't forget that Monday China briefing. That's 9 a.m. London, 4 p.m. Beijing. But also take a look at our other China coverage. It includes our China Activity Proxy, the CAP, which is an independent measure of Chinese growth. The accuracy of its readings are one reason why Julian's team was named most accurate forecaster of China's economy by Consensus Economics. That's a London-based forecast aggregator and distributor. Excuse the boasting, but that's it for this week. We'll be back next time with more from the front lines of global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.